Thank you for taking the time to listen to our loan modification presentation from Connect Financial Services. At Connect Financial, we offer both a loan modification and Equity Now program. Before we go through and explain each of them, I thought I'd give you an idea of the outcome you can expect when utilizing either of these two programs. Now, many borrowers are coming to us and they're upside down on their homes, so that's the scenario that I've reflected here. So let's say you've got a home that's valued at $400,000 and a loan amount of $500,000. The interest rate is 7.4% and the resulting payment is $3,462 a month. In a typical loan modification, you can expect that balance to remain the same, but the interest rate to be reduced significantly. This would result in a borrower saving about $1,100 or 1/3 per month. Their equity position would still be negative, but the hope is that home values eventually turn around and that equity position will eventually become positive. Now, in the Equity Now program, the loan balance is immediately reduced to the point that the borrower has a 25% equity position in the home. In this scenario, that would result in $100,000. The payment is reduced to $1,857 a month, resulting in about a $1,600 a month savings. Now, obviously, when you compare these two programs, you can see why we are excited to be offering the Equity Now program. But let's walk through each so you understand how both of them work. So let's start with what is a loan modification. And basically, a modification is any change to the existing note. That can typically be the interest rate. You'll see many lenders reduce interest rates from a 7 or 8% rate on an existing note down into the low 4s and sometimes even down to 2 and 3%, depending upon what the specific conditions are for that client and that note. You'll also see sometimes that the loan itself is extended from, let's say, a 30-year note to a 40-year note to reduce the monthly payment to make it more feasible for a client. And lastly, you'll see principal reductions. Now, if you take a look at 2008, 1.3% of the loan modifications that were completed between January and May of 2008 resulted in an actual principal reduction. So it's a very, very small percentage of the total modifications that are done that have that outcome. If you take a look at loan modifications that have been done so far, and if you measure success based upon the ability of a client to continue to make payments on their existing mortgage, they've really been a pretty dismal failure. 37% of existing modifications were already 30 days late after 3 months. Over 50% were 30 days late after 6 months. And if you take a look at 60-day lates, 37% of loans that had gone for 2 more quarters were 60 days late or more. So why does that happen? Well, it happens because those borrowers really don't have an equity position in their home. They've been modified, but very few of them have actually got a principal reduction. Home values are continuing to slide, and many homeowners really see no bottom and no way out to the problems that they have with their existing mortgage. Let's take a look at a sample mortgage modification. So if the client currently has a mortgage of $250,000 on a 30-year fixed principal and interest mortgage at 6.5% interest, the payment for just principal and interest is $1,580, and then of course you need to add taxes and insurance to that. In a typical modification, the mortgage amount would remain at $250,000, but they might potentially increase the mortgage term from 30 years to 40 years, reduce the interest rate to 4.5%, and then give the client a new payment of $1,123.91. And then again, you'd still have to add taxes and insurance, which would be the same as what it had been in the past. But then the borrower is going to save $456.79 per month. And that's a typical mortgage modification. Now, many people ask, why would banks be willing to do this? Well, they do it for a number of reasons. They want to avoid foreclosures to begin with because it does give them a bunch of bad publicity. And on average, taking a mortgage through the foreclosure process and then ultimately selling the property takes on average 18 months for a bank. So foreclosures are extremely expensive, especially when you consider the legal fees that are also associated with the foreclosure process. Banks on average, when they do get to the actual sale of the property, receive only 82% of the current market value of the property when the sale is actually completed 18 months after they've started the process. So it's expensive and it's lengthy, and they still don't get what the property is ultimately worth. Banks want to get rid of their non-performing notes for a number of reasons. In order for things to function for them properly, they have to continue to bring in new mortgages and sell them off in the secondary market. When they're stuck with a non-performing note, it's very difficult for them to sell it off in the market, and because of that, it sits on their books, and they can't continue to replenish their pipeline and sell it on the backside. That's where banks make their money. There's another reason why banks want to get rid of non-performing notes. It has a direct impact on the reserve requirement for the bank, and that's where you see a lot of the banks getting into trouble today. If you have a performing note, you only need to keep about $1 in reserves for every $100 that's outstanding in mortgages. But as those mortgages become late and they move to ever later buckets from 30 days late to 60 days late to 90 days late, that reserve requirement inches up from $1 per $100 up to $24 per $100. That creates huge issues for the banks because there's a specific requirement for them to meet their reserve requirements in order for them to maintain their federal charter. And that's why you see a lot of the banks running into issues today. Now, loan modifications that you see advertised today, they do work. You do see people get modifications and have their monthly mortgage amount reduced. Now, currently the DRE has about 12 companies approved that can take upfront fees. But if you listen to the market at all, you'll notice that there are many more companies out there advertising their ability to do loan modifications than the 12 that are approved with the DRE. We've worked with several of these in the past, 2 in particular, and they charge between $2,500 and $5,000 for their services. We have a better way than a loan modification to go through this process, and it involves the purchase of the note from a third party. What we do is we get a third party to come in, buy the note from the bank. The third party also, prior to making the purchase from the bank, goes in and does a forensic audit of your note. And that involves a couple of things. First, they complete a review of the truth in lending disclosures, and if you have a interest-only or a neg-am loan, the vast majority of those have issues when it comes to the truth in lending disclosures. We also review the loan for HUD compliance, and then once that's completed, we document a case against the lender to create a strong negotiating position for us to get the lowest possible price on the note that exists with the bank. When you combine the information that we have from our audit, along with the buying power that we accumulate by pooling together $40 million pools of individual investors or individual mortgage holders, we go into the Countrywides, Wells Fargo's, and Bank of America's of the world, and we go in and negotiate the best possible price to purchase that pool of notes. And that typically takes us anywhere from 4 to 6 months to group together enough clients so that we can go in and buy a $40 million pool from one of the major lenders out there. Once we have the audit complete and the pool put together, our investor goes back to the bank and negotiates the best possible price, and then we use a portion of the discounted price to provide the homeowner with immediate equity in their home. Now, to give you an example of how this might work, let's say that you have a $500,000 note on your property, but your property is only currently worth $400,000. So you're underwater by a total of $100,000. What we'll do is we'll go in with the investor, and after it's been pooled together and we've done our audit analysis, we'll go in and typically purchase that note from the lender for about $200,000, which reflects a 50% value of the current value of the property in the open market. At that point, the bank is going to realize an immediate $300,000 loss. and they typically get a replenishing capital amount through the government TARP program to replace that. Once that transaction is completed, the investor then creates a new note at 75% of the current market value. So once again, take that $400,000 current value at a 75% LTV, gives us a new loan amount of $300,000. Now if we go back to where the homeowner started, the homeowner had a $500,000 loan, and now they have a $300,000 loan. So they're relieved immediately of $200,000 worth of debt. The new home loan at $300,000 has the homeowner positioned with $100,000 in equity the moment that new note is signed. Now, we believe that the homeowner at that point is strongly encouraged to maintain payments on time because they're in a position to share in any increase in value that the house has, as well as take advantage of the equity that's already in place in the home once they've improved their credit, if they've already gotten to the point where they've got late payments on their credit report. If you like what you've heard so far, then you're ready for the next step. And the next step involves really a couple of pretty simple processes. The first is to fill out a loan application with us, which we're glad to help walk you through. And it's the same loan application that you filled out most likely when you got the loan that you're in today. It's important to note that your credit really doesn't matter. So if you've got lates from the mortgage that you already have in place, don't worry about that. That's not part of our concern here. The other thing that we're going to ask you to do is complete a contract with us, and you'll see in the contract the written guarantee for the principal reduction. And then lastly, there's a statement of information, which is a one-pager, just has some basic contact information in there for you. Once that's completed and we've received that from you, we'll then put you in with the other mortgages that we have already in place with other clients until we have a $40 million pool to go back to the bank to begin the negotiation process to buy your note. So your foreclosure is stopped. Now, if you are current on your mortgage and you're just going for the principal reduction, continue to make those payments so that you don't have a late hit your credit report, because once this is completed, it will have no negative impact on your credit. Once we have completed the negotiation with the bank, we will turn right around, write a new note for you. Again, you've got the principal guarantee that it's going to be reduced, and if it's not, your fee is returned. That's it in terms of what you do. I guess the next step is to either get back to the person that sent this to you, or you can call us at 310-770-6418. That's 310-770-6418. Or at 916-834-6225. That's 916-834-6225. I hope you enjoyed the presentation. We look forward to helping you out, and I think you'll be very pleased with the result.